Assalamualaikum, good morning to Media Razia. My name is Safira Usmani Fikri Saril, SMC 230709. I will present to you how to do the first question. Suppose the quantity demand of a crude increase from 120 units to 150 units when the price increase from RMA to RMC. Use the formula to calculate the price elasticity of demand for the consumer. Show all your work. First, we need to know the original quantity demand in this question, which is 120. And then the new quantity demand is 150. Next, we need to know the original price in the question, which is RMA, and the new price RMC. So this is the formula for the price elasticity of demand. We need to minus the new demand and the original demand and divide by the original demand and multiply the original price and divide by the new price minus original price, and we get negative 1, which is inelastic. For the question 2, what is the elasticity of demand for this product? Elastic, inelastic, or unitary elastic? So we get the answer is negative 1. So negative 1 is inelastic. It is because the change in price doesn't lead to much change in its demand. So it means the product is considered as a necessity or a necessary item for additive constituents such as petrol. So that's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh, and very good morning to Media Razia. My name is Siti Suhaja binti Sabri. My ID is SMC 23070270, and today I will present to you about question 2, which is cross price elasticity of demand. Okay, so the question is, the demand for food A increased from 150 units to 180 units when the price of food B decreased from 4 ringgit to 3 ringgit. Okay, so the question wants me to calculate the cross elasticity of demand for food B using the given formula. Please show all the workings. Okay, from the question, we need to look at the formula first. So the formula for cross elasticity is new quantity minus the original quantity divided to the original quantity. Multiples to original price divide to new price minus original price. Okay, so from the question, we identify the new quantity, which is 180 minus 115 divide to 115. Okay, so multiple to the original price, which is 4 ringgit, divide to 3 ringgit minus 4 ringgit. So from the calculation, we get the answer that negative 0.8. Okay, so negative 0.8, we know that is a complementary because it was negative. Okay, for the question 2, provide an explanation for your answer. Okay, cross elasticity of demand refers to the way that changes in the price of one good can affect the quantity demand of another good. The answer that we get from the question is negative 0.8. So the cross elasticity of demand is complementary goods. So as the price for one item decrease, item closely related to that item and necessary of its use increase because the demand for the primary item has also increased. That's all from me. Thank you.
Hi and Assalamualaikum warahmatullahi wabarakatuh to Media Razia. So my name is Nur Shazira Alisa binti Abdul Rahman. My ID number is SMC 23070164. So I will explain to you about question 3, which is income elasticity of demand. Inferior goods have below zero income elasticity of demand. So the question number 1 is, explain the statement mentioned above. My answer is, higher income level typically translate into a preference for high quality products. As income rise, demand drop for inferior items. Therefore, the demand for inferior item income have the opposite relation according to the concept known as negative income elasticity of demand. Say into another perspective, if you have more money, you probably won't purchase as many inferior items since you can afford better option. This tendency is captured by the negative income elasticity of demand for inferior product, which shows that desire for inferior goods decrease as income increases. So that's all from me for question number 1. Okay, now let's proceed with the second question. If Sol's income increases from 50,000 to 75,000 in a year, his demand for the goods decreases from 6 units to 3 units. What is the income elasticity of demand for this good? So how to calculate this? I make a table and I divide income level and quantity demand. So the original price is 50,000 and the new price is 75,000, and the old unit is 6 unit and the new unit is 3. So using this formula, I already do the calculation here. So as I said just now, 3 is new quantity. So new quantity minus original quantity divided by original quantity multiply original price divided by new price minus original price. So 3 minus 6 divided by 6 multiply 50,000 divided by 75,000 minus 50,000. So the answer is -1. Okay, for the last question, question number 3. Please explain the type of this product based on the information provided above. So my answer is, if income increased by 1%, the quantity demanded of goods X decreases by 1. And it represents inferior goods since the relationship between income and quantity demand of X is negative. So that's all for me. Thank you.
My name is Nur Aisyah Kristina binti Muhammad Khalid and SMC 2307-2017. I will explain about special form. Okay, for special form, there are 3 sub first one. At the price of RM400 for good X, the quantity supplied is 200 units. As the price increases to 600, the quantity supplied also increases to 500. For this question, the formula is Q1 minus Q original quantity divided to original quantity times original price divided into new price minus original price. Okay, so this is the equation. So what I do is 500 minus 200 divided to 200 multiple 400 divided to 600 minus 400. So we got 3 is elastic. So sketch and explain. For the graph, this is the graph that suitable for elastic. And for the explanation, the change in the price of the goods causes the bigger percentage change in the quantity supply. That is for question the second question. When the price of good Y increases from 400 to 500, the quantity supply of wood Y increases from 300 units to 330 units. So this is the equation. I do is 330 minus 300 divided to 300 equal 400 divided to 500 minus 400. So we got 0.4, which is inelastic. So this is the sketch of the graph. And for the explanation, change in the price of the good causes a smaller percentage change in the quantity supply. That is for question 2. For the last question, when the price of good Z increases from 500 to 600, the quantity supply increases from 400 units to 480 units. It's 480 minus 400 divided to 400 multiple 500 divided to 600 minus 500. What I get is 1, which is unitary elastic, and this is the sketch of the graph. The change in the price of the good causes unequal changes in its quantity supply. That is all from me.